What's up, guys? So I'm on Zoom with it, and I have a very special episode today, right? So again, what's up? I'm on Zoom with it. So I have a very special episode that I'm going to do today for you guys, okay? So this new episode that I got in mind is, every single week, I'm going to post a video. I'm going to go through a stock in each sector. So we have 11 sectors in the stock market, if you guys didn't know. And I'm going to go through a stock within each sector. I'm going to comb through their fundamentals, their balance sheets, their cash flow, their income statement, and all of these sort of things. And look at some indicators, of course. And then, I'm going to post it every single week. I'm going to let you guys know if I feel like it's a buy or not, or like, if you guys should, if you want to buy, you can. If you don't, or if I would buy it, something like that. So I'm going to do that every single week. It's going to be really fun. I think it's going to help a lot of you guys, especially knowing how to, evaluate an entire stock, an entire company, because that's what I do all the time. I like to comb through their balance sheet. I like to comb through their income statement. I like to comb through their cash flow. I like to look at certain indicators. I like to look at a whole bunch of things, and then that's what I'm going to show you all today in this video that I'm going to drop. I'm going to do this every single week, a stock from each sector, and I'm going to let you know if I think this stock is a buy right now, or if I think that you should, wait, or if it's just dead in the water. Okay, guys? So what I'm going to do is I'm going to share my Zoom screens. We're on Zoom, and I'm going to get straight to it, okay? Give me 1 second. Actually, I have to open it. All right, guys, I'm getting my Google Chrome up and running. And once it is, then I will jump right in. So where's my Zoom app? Okay, back to here. And there we go. We're gonna share the screen. No. Share. All right, cool. I know you guys can see me. I'm gonna move this down. I want you guys to see me. So first, let's get it. So we're gonna go to one of the sectors. Let's see. We're gonna go through XLV. Okay, so that's what I'm gonna comb through right now. Go straight to XLV. It's a health sector. We're gonna take a look at a stock in there. So first, what you want to do is go type in Morningstar. It pops up. See, Morningstar always wants me to sign up for the premium. You can use it without premium. I'm good. So I go here. I don't need much. So then I type it in the quotes right here. Where we at? There we go. And then again, it's XLV. So use it up a little bit. Hope you guys are doing well. Click on that. So XLV has, I don't know, it has 3 stars. I don't know if that's accurate. Last time I saw it, it had more than that. So I don't know why this is. Let's see. It had 4 stars. Am I? Well, yeah, it's got to be XLV. Well, let's see what we got in it. So here we go. So we're in XLV. And this is the holdings they have. And I don't know, let's see, I don't know how I'm gonna choose what I should choose. These are the top holdings that XLV has. And I like to use Morningstar because I get to see this. I mean, I can go to Google and Google it up, but I'd rather just come here and stuff. And it's pretty easy. So I don't know which one I should do. I don't know how we're gonna do this. If I should just choose a random one. Yeah, so I guess I'm just gonna choose a random one. Uh, let's take a look at Medtronic PLC, right? So is this one right here? So Medtronic PLC. Let's take a look at it. Okay. And what we're gonna do is we're gonna get out of here, and we're gonna go straight to um, Yahoo Finance. Let's go straight to Yahoo Finance. That's my buddy right there. Yahoo Finance. I use it all the time. Probably spell finance all types wrong. Yeah, I did. And we're gonna go straight here. So Yahoo Finance. Then we're gonna type it in. Where is the ticker for this? What was it? Medtronic. I think I could just type in the name. That's going wrong. There we go. Medtronic. It was Medtronic. All right, guys. So we're right in here, and let's take a look. So as you can see, the cost is $103.56. Let's take a look here and see volume about what's that? Is that 30 million? I'm assuming. Yeah, 30 million. And you can see the P ratio, which is 31.77, a little high. Generally, they want it to be about 15 to 20. Most investors, it's a little high, but it's not too bad. Most tech stocks, their P ratio is a lot higher than that. EPS, earning per shares, is pretty good. Usually, it's 1 and above is good. Anything above 2 is really good. So this is really good, actually. You have some EPS that are negative earnings per shares, but this is about 3.26, so not bad. It's pretty good. Um, let's see. Well, I believe so. Yeah, they have dividends as well. They have ex-dividend coming up on September 24th, 2020. So this is showing you whenever the day that I believe that you need to purchase your dividends by for you to receive. So for you to receive dividends, yeah, I think that's the date that you need to purchase it by. I guess we can take a look at their dividends information real quick. That's not. I mean, it helps. They have dividends, so that's good. Where is it? Let's see stats. Stats. So let's go to stats. Okay, there we go. Oh, okay, so the payout ratio is 67.48, which is really good. That's not bad. Usually you want your payout ratio to be under 100%. So it means that whatever the company's earning, they're only paying out about 67% of their earnings to investors. So they're keeping a good 30%, 34%, something like that, to themselves, and they can distribute that to their company. And do some asset allocation, make things better for their company. So that's pretty good. I think Apple, theirs is like 30%, or yeah, it's like 30 or something. So Apple's really good. Yeah, so the exhibit date is September 24th. That's the day you need to buy. You need to buy this company before September 24th to receive the dividends on October 16th. I mean, that already passed, so it's just showing you the ones that passed. Well, which is whatever. It's Yahoo Finance. Sometimes they don't have enough staff, I believe, to update everything. So, well, we got that out the way. Let's take a look at financials. This is where I really want you guys to look at and focus on. And we're going to start here. So total trailing months means like the months within this year, pretty much. And this shows you that time frame whenever they had this information, 4/30/2020, and all these other time frames over there. And all numbers are in 1,000. So that means these aren't, this isn't 28 million, it's 28 billion and 30 billion and stuff like that. So, yeah, I believe so. Yeah. And so what we're gonna do is gonna go through their, yeah, let's go through the income statement. I'm gonna look at all 3 of these sheets, and then we should be a-okay, guys. So let's look at the income statement and expand it bigger. So we're gonna look at their total revenue. So what I like to do when we look at total revenue is we gotta look from the past, so from 2017 all the way up till now the recent one that they have, and see how their total revenue has been increasing. So as you look at Medtronic, I believe this is what it is, MDT. You see that it starts at 29 billion, and then you have another 29 billion as well. It's increasing. So you have 30, and then you have 28. So it actually had a drop in 2020 in terms of their total revenue. That's not really alarming, being that they're bringing a lot of cash. Regardless, that's not really alarming. But again, you do want it to have subsequent increase year after year. So you kind of want to take that into mind. And you see the total trading months of this past year. Yeah, it's down to about 27 as of right now. Operating revenue means how much it costs for them to operate. So that means pretty much expenses, if you think about it. So if you have a lemonade stand, right, that's what everybody likes to use. We have a lemonade stand, and it costs you how much to, let's say it costs you $1 to get the lemonade, and it costs you another $1 to get to get the lemons. It costs you another $1 to get the pitcher. It costs you something else like $3 to, let's say it costs you $3 to create an entire lemonade stand, and then you're selling your lemonade and you're bringing in like $5, and then let's say you bring in $5 the entire day. So your operating expense was 3, you made 5, so you're taking home 2. So your revenue is 2, right? And you do that over time and over time and over time. So that's what that means. So operating revenue, well, usually they are going to increase as when total revenue is increasing, just because they're doing more expansion. And as you can see, it's equal. So that's pretty strange. No, I'm sorry. Yeah, they're supposed to be equal. They're supposed to be equal. So this is the cost of revenue. So that's what I'm talking about. The cost of revenue. So with the lemonade stand, again, the cost of them earning this total revenue. So the cost of you building that entire lemonade stand, right, it's going to be deducted from what you're earning, of course, in that maintenance of it. So you got to keep buying lemons, right? You got to subtract that from your revenue as well. Because think about it, that's how businesses work. So it's the cost of revenue. Again, I'm sorry about that. So as you can see, it's 27 right here, and then the cost of revenue it's about 9 billion. So the gross profit is going to be subtracted from these two numbers. As you can see, it's 18 billion for their gross profit. Okay, so because of that, they're doing pretty well in terms of, because it's not too much. It's pretty much they're making a good amount. Their cost of revenue is not that much to where they're not having any gross profit. So they're keeping a lot of money on hand, and they'll be keeping their cost of revenue about 9 billion for the most part. So they've been keeping it at 9 billion for a while. And as you can see, their gross profit it started increasing in 2017. It's been doing well until you get to 2020 and the trailing months. So it's been decreasing these a couple of years, and you want to take that into account. But as you can see, the cost of revenue is really minuscule to how much they're keeping on debt. So that's really good as well. But let's keep going. So. All right, guys. Let's look at. Yeah, so that's pretty much what I look at on the income statement. Really, is just those two numbers, and then yeah, that's pretty much it. I don't think I look at much. So yeah, those because that's important. The cost of revenue is important, and the gross profit is extremely important. That's letting you know how much they're taking for themselves after they've paid off that operating cost. They paid off their cost of revenue. So that's really important, and you got to make sure that it's increasing year after year. If their cost of revenue is higher than what they're taking back, then that's not a company you want to invest in. All right, guys. So let's get out of the income statement. Those are the only two things I look at with income statement, and let's go to balance sheet. Okay. And here we are, the infamous balance sheet. So ended. Yeah. All right, guys. So again, same thing with the balance sheet. This is the total asset. So this is just how much the company has in terms of their assets within that year. So it's a total asset. So within that year, how much is that company? What can be liquidated into cash? What can be counted as an asset for that company? So they're counting everything in that company that counts as an asset for them. Okay, so that can be anything. I'm not privy to that information. What they're counting as assets, of course, but yeah. So you want to make sure that also is increasing as well, right? Because you want to make sure that they're still retaining those assets. They have a lot of assets. They're still doing well. So from 2017, they had about 99 billion. 2018, 91. 2019, 89. As you can see from those three numbers, it's already been a decrease. 2020, the cost, their assets went back up to 90. But again, these three past years are really alarming. Well, not really extremely alarming. We can take a look at the current asset and their current debt. But these numbers, yeah, they are decreasing subsequently. And trust me, you can find companies that theirs is actually increasing. So yes, they have their assets. It's a lot. They have a lot of assets. The cost, which is pretty high. But again, it is decreasing every year. So that's something you want to make sure that you're taking into consideration. So let's look at current asset. And this is what's really important as well. One of the most important things on the balance sheet, because it lets you know what's the current asset that company has within that time frame, within that year, pretty much. So total asset is really like accumulation for like the entire company asset, not necessarily within that year, just like the entire asset that company has, in total. So current asset is actually within the year, how much asset they have within that year, okay? So within the 12-month period, okay, within the 12-month period. So as you can see, currently within the 12-month period, they've also been decreasing. So 24 billion, 22, 21, and we're back at 22 again. So, 2020, it looks like they're kind of pulling their weight, and, they're doing not as bad as previously. So they're trying to ramp up their assets. So that's not bad. But again, those subsequent years that it was decreasing, can be something that you want to, make sure that you are aware of course. So we have current assets. So that's good. So it's not bad. It's pretty good, actually. You want to take a look and you want to see, let's see. Yeah. Those are just like what adds up to it. So that's not really anything super important. But you want to take a look and see their current liabilities, right? So why is that important? Current liabilities show you their liabilities that the company has within that year period, right? So same thing with current assets. What the assets that company has within the 12-month period, current liabilities, the liabilities the company has within that 12-month period, anything that needs to be paid back, anything that's taking money out of the company, certain things like that, debt or anything. So when you have current liabilities, well, that is also gonna, it's gonna fluctuate as well. But what you want to really make sure of is that they have enough current asset in that company, right, to basically pay off the current liabilities within that year. So if the current asset is smaller than the current liabilities, that is the company that you want to stay away from. That means they have more debt and more liabilities in that company than they have current asset. So that means that they're like a zombie company. They don't have anything. They're keeping afloat through like debt, and they have large operating expenses probably. So, they're not, so when you want to make sure that a company does have enough current assets to pay off their current liabilities within that year. Okay, guys? So what's the current liabilities? Okay, so yeah, here it is, guys. Hope you guys can see it. So stat blue right here. So as you can see, as of right now, it's about 10 billion, and and you look and we see that their current asset was about 22, right? So what we like to do is, let me show you something, guys. You want to do the current asset divided by the current liabilities. Of course, as you guys can see, it's they have enough to pay that off within a year and still have about 10 billion in current asset. So that's really good. They can pay their debts twice, pretty much. They can pay it twice. But let me show you a little equation that we as investors like to do. So you want to do 22 divided by 10. So it's 2.2, right? So that means they can pay that debt about twice over and still be okay. Pretty much, they can pay it about twice over and be fine. So that's really important. And this is not bad. They're doing pretty good. They just need to make sure that their assets is going up and also their income as well. Other than that, they're not doing too bad. And yeah, okay. So looking for, I usually check this on my phone, so it's a little hard to show liabilities net. That's it. I'm trying to see. Okay, so this is where we're at. So you see their total non-current liabilities. That means that it's now they don't have to pay back within a 12-month period, that liability that they have. This is like further out liabilities that they need to pay back within like uh, within out of the 12-month period. Okay, so you can see it's 29, and the current was what, 10. So it's about 39 in terms of total liabilities. Is about 39 billion dollars, and so yeah, this should be it. I believe so. So yeah, it should be around 39. Yeah, $39 billion for the total liabilities. Okay, for this year. So, or not for this year. I'm for like their accumulation for what they have in total from their total non-current and their current. And then you want to take a look at their total asset, right? As you can see, their total asset is $90 billion, and their total liabilities is 39 billion. So that this company is actually in good shape. Honestly, it really is in good shape. Think about it. They have enough. So I mean, we can do the math for that too. It doesn't really necessarily matter. But 90 divided by 39, they have enough to pay it twice over as well, about 2.3 times. So to pay off their debt. So totally. So and still have money left over. Not really have money. They have enough to pay it off twice. So you can see this company is in good shape. If you have 90 billion and you have around 39 that you have to pay back, you're in good shape. So um, this company's not bad, honestly. And let's see, what else do I like to look at here? So another thing I like to look at is their stockholder equity, right? So stockholder equity is important because it just shows you. Actually, before that, I don't want to just say. Let's Google it up. I don't want to say anything. Sometimes I'll be forgetting these terms. So stockholder equity is the amount of assets remaining in a business after all liabilities have been settled. It is calculated as a capital given to a business by its shareholders, plus donated capital and earnings generated by operation of businesses, less any dividend issues. So it's basically so as you guys heard, it's basically what's left over after the company has paid off its liabilities, and that's really for the stockholder. So they can give that out in terms of dividends. They can give that out. They can make it where the company is perform like they're doing some kind of um, they're buying assets for their company or anything like that. So it's really good for the shareholders to have an increasing stockholder equity. That means they have enough money to give to us, to the people who hold shares in that company, right? In terms of dividends, and they can still keep it afloat for a good amount of time. So stockholder equity. So as you can see, it's at 50 billion, increased, it decreased, and then it's back up again. So at least it's been staying within the 50 billion range. So they've been keeping it pretty steady. So if you're a shareholder, you don't really have much to worry about with this company in terms of if you're going to get your dividends, if the asset is going to appreciate, because apparently, obviously, by looking at this, it is going to continue to appreciate. You know, so and they're going to continue to do what they need to do for that company. So that's really good. Yeah, that's pretty much it. I mean, I like to look at retained earnings as well. Let's Google that up too. So retained earnings is the amount of net income left over for the business after it has paid out dividends to its shareholders. Often this profit is paid out to shareholders, but it can also be reinvested back into the company for growth purposes. The money not paid to shareholders counts as retained earnings. So that's also important as well. So yeah. Oh, here we are. So that's important because it's showing you that, you know, um, this is what's left over after the company has paid, their shareholders their dividends, and this is how much they're retaining. And they've actually been doing well. So it looks like uh, maybe yeah they've been the retained earnings been increasing. So either they're making more, they're giving out less dividends or something like that. But it's still good because it's just showing you the company they're having money left over to do any other necessities that can also be a benefit to the company and which will be a benefit to its shareholders. So you don't want to have a company that their retained earnings is nothing, unless if it's a REIT or something. Their retained earnings is there's nothing. That means that they're literally giving every earnings that they're getting to the shareholders, and that's how they're trying to get people to continue to buy into their shares. And that's not really progressing the company. You want something that is going to progress the company, and the company is going to keep progressing. So the retained earnings is pretty good as well. I like it. Yeah, they're doing really well. So, and that's it for balance sheet, guys. And last but not least, we gotta look at the cash flow. So, so when I go to cash flow, I don't really look at much like this in entirety like that. I don't look at much like that. Um, the only things I look at when we look at when I look at cash flow, is the free cash flow, and they're just showing you how much the company, again, the cash they have. Let me see. So I'm gonna make sure you guys are getting everything that you need. So we're on the Investopedia. So free cash flow represents the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. Unlike earnings or net income, free cash flow is measured off of profitability that excludes the non-cash expenditures of the income statement and includes spending on the equipment and assets as well as changes in the working capital from the balance sheet. So basically, it's saying that the free cash flow is pretty much after the company, what is left over after the company has done everything, paid everything, in terms of keeping their assets, things like keeping their assets up to par, in terms of, just anything they have to do, dividends, payouts, in terms of, yeah, anything that includes expenses, pretty much. So the free cash flow is what's left over for that company to be able to generate assets, to be able to just money that they have on hand and able to for them to kind of continue to grow and have and maintain its capital assets pretty much. So let's see. Yeah, so you want to make sure when you look at the free cash flow that for a company, you want to make sure that it's also increasing subsequently as well. But as you guys can see, well, it's been decreasing. Well, they had a rough 2018. Um, that's 2018. Should be 2018. Let's see. Yep, 2018. They had a rough 2018, man. But after that, they bounced back and they earned more 2019 than 2017, and it's been going up. 2020 hasn't been looking so hot because I'm assuming they just haven't been earning as much. So yeah, well, for the trailing months that we've had, it hasn't been doing as hot. But they still have cash on deck, for any expenditures that they have to do. So they still have a good amount of money on deck. So about 4 billion. So it's looking it's looking pretty good. They just need to work on certain things, I think, and then it will be okay. So they're not doing too bad. I really like their balance sheet. I really like their balance sheet. Their free cash flow needs some work on what they got going on. But other than that, they're doing pretty well. So that's all I look at. Um, unless if it's some type of like, because it's like they came back in 2019 and they did well like in like the first couple of months in 2020 and now the trailing months now it's like all right but I can't blame them because of what's going on with the situation. So yeah, so I mean they're doing well as you guys can see. So another thing that I like to look at, it's very extensive, right? It takes a while, man. So I like to also look at the companies. Let's see. So we go back to summary, and what I like to do is, what's the chart? It's hard for me to do the chart. Here we go. There we go. Awesome. So I like to look at their chart, and then I want to change it from 1 day intervals to 1 year. I always change it to 1 year. It looks a little strange. Or let's do year to date. Oh, not the intervals. I'm sorry. You can do the intervals. Yeah, the 1 day, 1 day. I'm sorry, intervals, 1 day. You want to change the date range right here to year to date. Sorry about that. I usually do this on my phone. So yeah, so year to date, and an interval is 1 day. So then what else I like to do as well is put up some indicators. I do have a course where I'm teaching people all of this stuff, but I want to show you guys how I mold the entire process into one, right? And yeah, I just want to show you guys how I do it. So let's take a look here. Let's add, and we can add the moving average, right? Let's keep it at 50. Save, and then we're gonna add. Let's see, or the RSI. Keep it at yeah. This is not. It's not bad. As you can see, the RSI is at 46. So it's not too bad. Well, it's starting to pick back up steam. Okay, so indicators, awesome, love them. Moving average, RSI, love them. I can also put up the Bollinger Bands, but it kind of does the same thing. So I guess we can pull that up as well. But love them. Okay, so as you can see, during October, yeah, they had a huge sell-off right here, and so this laminar line you're looking at is a moving average indicator. That lets you know when a stock is trading at a certain moving like day average, like moving day average, to let you know that it's it's trading at a lower price. So we're at 50 days. So it's saying it's below its 50-day moving average. So that means that it's trading lower in price than what it's usually been trading within those 50 days, right? So as you can see, it's still trading lower. I mean, the price is starting to go up. So this is not a bad purchase right here. It's at it's not a bad purchase. I mean, right now it's at 103, I believe. So it's not bad. And when it gets to its 50-day moving average, it's going to be at 105, 73, so $105.73. So those small price difference can mean a lot, So with the 50 days, it's underneath, which isn't too bad. But I do like to buy things around its 100-day moving average, especially since what's been going on in the market recently. And you want to get the best prices you can for stocks. So you want to do safe. So yeah, it's above it, as you can see. When it's below it, it's at $101.09. It kind of kissed it right here in October, but it's still not too bad. I wouldn't say it's too bad because even when we had that drop in October and September, it still didn't go below it. So it's been trading pretty steady, honestly. Usually most stocks went below it around this time. So it's been trading pretty well, as you guys can see. So it hasn't been doing too bad. Take a look here. Yeah, yeah, it's not doing too bad. And then we like to look. I like to look at the RSI just to let you know what's going on. If people are selling it off or if people are buying. So as you can see, it's kind of in the middle. So it's like it looks like the like people are starting to purchase it more, and it's becoming, uh, you know, so it's becoming a little overly purchased, right? So people are buying it, are starting to buy it. So it's going up, and then whenever it touches this line right here, the 80, as you can see, that means that it's kind of pretty much there's a lot of people buying it. So you want to be careful of that. So, that means usually that means the price is also becoming higher because there's a lot of people buying it. So then you want to be careful when it touches that line, and then usually when it does, it's gonna kind of dip down as well. And when it kind of goes to the 20, that means that it's undervalued, and that means there's not a lot of people who are buying the stock. The more people are selling it than buying it. So when more people are selling it, that stock is becoming cheaper. So that's when you want to buy it when there are more people selling it because out of fear. So that's really what I like to do. Um, I really love the moving average indicator. I'm not gonna lie, it's like my favorite thing. It's so simple. I'll just buy whenever it's below after you looked at the balance sheet. And honestly, this company is a pretty good company. I don't think it's bad. I think they have to work on certain things, honestly. And if you were in this company, you might have a little bit of down days, of course, but I still think it's a good company. And maybe there's one more thing I want to look at. Well, I guess you can. I also like to do as well is kind of compare because I can't get on. Well, okay. So I'm gonna just do one more thing. Kind of, you can get like another stock from the sector and anything. Let's look at Merrick and let's see what they're trading at. And I like to compare um, the percentage and see because this was down whenever the market closed on November 6th. So I want to see the other stock within that same sector and see, oh, were you down as well, or like how are you doing? That also helps me make my what my choice. So can we add it? Yeah, comparison. You can do. What is that? There we go. Is it gonna give me? Well, you're not gonna give me the percentage. Well, they're going up, so they're doing pretty well. You can kind of see they kind of align. They align pretty similarly. So that's why I always like to do that. Because you can tell which one is stronger by looking at what they're doing within that same day. Um, let me actually. I'm gonna close this one. Close you. Well, I can only X this one out. All right, guys. So just remember the number. So what is it? 0.43%. Remember that number? And let's go take a look. Oh, see, 0.12%. So not too bad. You can even compare it against the actual sector and see if it's doing better than the sector. And the sector was actually up. So that goes to show you, man, the sector was up, but the stocks within the sector, they were down. So that's why some people like to do ETF investing because you're getting collective, and there's stocks in there that's doing better than the others and pulling it up stronger than what you would do if you were investing into just a singular company. And that's a prime example that we just looked at, right? That's a prime example. So is Medtronic a buy or not? Let's see. Let's see. No, is it Medtronic? What am I saying? This Medtronic. Yeah. Uh, come on. Take me back. You don't want to take me back? There we go. Is Medtronic a buy or not? Well, let's see. And we can take a look at their earnings. So, what Yahoo Finance also does is it gives us an image of their earnings in a nice little graph like this. And, well, it's not doing too bad. It's just that 2018 was just a hit, man. Um, yeah, I would say Medtronic is a buy. I would say Medtronic is a buy. Um, let's see. I'd say it's a buy. Live deliberation. Let's take a look. Let's see. So I'm back on Morningstar. Sorry, guys. Is this thing even gonna show me that what I need to see? Well, I guess I'm just gonna show you guys on my phone because there's one more thing I want to look at, but it's gonna be difficult for me to do that on here. So this is what I'm gonna take a look at, guys. I'm gonna go into Robinhood, and I don't want to log into my thing on right here where I'm looking at you. So I like to look at their 5-year chart, and I just feel like Robinhood has an easier looking chart to look at. Yeah, so we're gonna do it that way. Yes, so I just like to look at their 5-year chart and just see how it's been doing, see their subsequent increases and how they're bumps in the ride. So I'm gonna show. It looks like so this is it's going up as you guys can see. So it looks like Medtronic, it's had some bumps and bruises along the way, right? It's had some bumps and bruises. Um, that's what I was feeling too. Holding this, you will have some dips. Um, you just tell, but at the same time, it's still a good company. And if you, yeah, it's still a good company. I mean, 5 years ago it was at $74, and now it's about, well, in 2020 it hit its peak before COVID, and it was at 120. So it hit about a 60% gain in 5 years. So not too bad. It's about $45. Not too bad. You can see all that on Robinhood just by moving the graph and looking at the percentages. So it's not too bad, guys. Yeah, I say it's a buy. I say it's a buy. Yeah, I'll buy it. Yeah, it's a buy. But again, just know you're gonna have some bumpy time, a little bit of bumps. You just gotta hold it, man. As you see, in 5 years, it did pretty well. I would think you want to hold it for at least 5 years, of course, but it's definitely a buy. I just like the way their balance sheet looks, and they still have good cash flow on deck. They're retaining their operating cost is not too bad. It's not too high actually. It's pretty good. It's only 9 billion out of like what was it like 22 billion or something like that. So it's really good. I mean, we can look at the we can look at their income statement again and see what their yeah man their cost of revenue total revenue the cost of revenue is only literally only 9 billion, man, opposed to 27. And they're taking their gross profit is 18 billion. They can do so much with that. That is really good. It's not bad. So yeah, guys, it's a buy. It's a buy for me. It's a buy. So I hope it made sense what I do. I do add a little bit more pizzazz and stuff from here to there. I might look some other certain things up, but this is really a good place to start. A good general consensus, um, and just like that. And it's a buy as of right now because it's still under its 50-day average, and it kissed its 100-day. I usually like to buy things at 100-day, but it's a buy right now. But if you want, you can wait for the 100-day. I think it'll probably get there again, most likely. But it's kissing it right. It's going up right now. It's the RSI is still low, so there's still a lot. It's not really a lot of people buying. So you're still getting at a pretty good price, and that's what I do, guys. Hope you guys enjoyed it, and thank you for staying with me. All right, peace.